24 hours, maybe less. That's how long some retail dealers have before their silver inventory hits zero. Not low, zero. And we're not talking about a temporary logistics hiccup. According to recent dealer reports, this is the beginning of something that hasn't happened since 2008. The physical metal is disappearing from the market. Right now, as silver touches $60 per ounce, the highest level in modern history, retail buyers are discovering something terrifying. You can see the price. You just can't get the metal. I'm not a financial advisor. This isn't financial advice. This is an urgent analysis of what's unfolding in the physical silver market based on publicly available dealer reports, industry data, and first-hand accounts from bullion retailers across multiple continents. Here's what you need to understand immediately. The disconnect between paper price and physical availability has never been this severe. The system is fracturing in real time. December 10th, 2025, silver trades at approximately $60 per ounce, up roughly 100% year-to-date according to market data. The best performance since 1979. Gold-silver ratio compressed to around 70-1. Every fundamental indicator screaming higher, and retail dealers can't keep metal on their shelves. Reports from Canada. The Royal Canadian Mint has placed silver maple leafs on strict allocation during what should be a slow period. Industry veterans describing this as potentially catastrophic. One major Canadian dealer stated bluntly that if maple leafs become unavailable, it would be, quote, close to end of the world for the Canadian precious metals industry. These aren't minor coins. Silver maples represent the backbone of North American retail silver sales, and they're being rationed. Reports from the United States. Major bullion dealers reporting 7 to 10-day delays on standard silver bar deliveries. Physical premiums, the amount above spot price that buyers pay for actual metal, have exploded to 8 to 12% for bars and rounds. In some cases, according to market sources, certain popular silver coins are trading $9 to $12 above spot. That's not a premium. That's a scarcity signal. During normal market conditions, premiums run 2-5%. When they reach double digits, something fundamental is broken. Reports from Vietnam, perhaps most alarming. Dealers reporting they cannot source raw materials to mint new silver products. Not finished coins. Raw silver itself is unavailable in sufficient quantities. The supply chain isn't just stressed, it's severed at the source. This isn't speculation. This is dealers paying up to $55 per ounce in wholesale markets just to acquire inventory while the spot price quotes $58 to $60. That inversion doesn't happen unless physical scarcity has overwhelmed the pricing mechanism. Look at what's happening in the derivatives market. Silver ETFs like SLV reportedly experiencing borrowing costs for short positions surging to nearly 10%. Available shares to short have hit zero according to recent trading data. Lease rates, the cost to borrow physical silver, have spiked to levels indicating extreme stress. Not quite the 200% plus rates seen during historic squeeze episodes, but climbing rapidly. And here's the technical signal that professionals watch. Backwardation. Silver futures have repeatedly flipped into backwardation throughout 2025. That means spot prices trading higher than futures prices. In normal markets, futures trade above spot to cover storage and financing. When that inverts, when traders value immediate delivery more than future promises, it's the hallmark of physical tightness. The market is screaming that physical metal right now is worth more than a promise of metal later. This is the supply squeeze manifesting in real time, not in price charts, in actual inability to obtain physical metal. Let's establish the mathematical reality underlying this crisis. According to industry tracking from sources like Metals Focus and the Silver Institute, the silver market has run consecutive annual deficits. The cumulative shortfall reportedly exceeds 800 million ounces since 2021. Some estimates suggest over 1 billion ounces drawn from existing stockpiles in recent years. Current year deficits estimated around 95 to 200 million ounces annually, depending on the data source. Global mine production around 830 to 900 million ounces. Total demand approaching 1.1 to 1.2 billion ounces according to consumption forecasts. Every single year, more silver consumed than produced. Every single year, existing inventories depleted to fill the gap. Where did that billion ounces go? Consumed, irreversibly. Industrial applications don't return silver to the market. Solar panels installed on roofs, silver paste in photovoltaics, electronics components in landfills, electric vehicle contacts permanently embedded, medical devices, 5G infrastructure, water purification systems. Approximately 60% of annual silver supply consumed industrially, according to analyst estimates. And industrial demand accelerating. Recent projections suggest global solar installations could require over 5,000 tons of silver annually just for photovoltaic applications. Electric vehicle production targeting 20 million units annually by some forecasts. Each EV using 25 to 50 grams of silver, electronics, infrastructure, technology. structural consumption rising while mine supply stagnates or declines. And here's the critical detail most miss. Roughly 70% of silver production comes as a byproduct of copper, zinc, lead, and gold mining according to industry data. When those primary metals become less profitable to extract, silver production falls as collateral damage. Primary silver mines alone cannot compensate. The supply response cannot scale with price the way most commodities do. This makes silver fundamentally inelastic on the supply side. So you have structural deficits persisting for years, industrial demand accelerating irreversibly, mine supply unable to respond quickly. And now, the investment demand wave hitting simultaneously. Silver ETF holdings reportedly surged to around 839 million ounces as of early December 2025, the highest level since mid-2022, according to market tracking data. Inflows in recent weeks matching some of the strongest periods since 2020. Institutions recognizing the deficit. Retail investors mobilizing. Central banks in some nations adding silver to reserves. Russia reportedly announced plans to expand precious metals holdings with 535 million in silver acquisitions over 3 years. All of this demand competing for the same physical inventory that's already depleted from years of deficits. The system had buffers. Stockpiles accumulated during previous decades. Those buffers are now exhausted. And when buffers run out during a supply deficit, the adjustment is violent. Wall Street doesn't publicly panic. They reposition quietly. But the signals are unmistakable. COMEX registered silver inventories, the metal available for immediate delivery, have declined significantly from peaks earlier in 2025. Eligible inventories being drawn down as metal ships to London and other markets experiencing even tighter conditions. The London Bullion Market Association reporting available silver inventories contracted substantially since 2019. Physical metal increasingly locked in long-term commitments rather than available for trading. Industrial users reportedly scrambling to secure multi-month forward supplies. Manufacturers building strategic stockpiles. Solar panel producers, electronics companies, EV manufacturers locking in supply at premiums to avoid production delays in 2026. This isn't speculative buying. This is industrial necessity. Companies that need silver to operate are paying whatever it costs because the alternative is shutting down production lines, and institutional investors running the same calculations. BlackRock, Morgan Stanley, Sprott, major asset managers reportedly increasing silver exposure according to trading desk sources and ETF flow data, not gradually, aggressively. They're modeling the supply deficit, they're calculating potential returns, and they're recognizing the mathematical inevitability. Silver market capitalization remains extraordinarily small. Total above-ground investment silver estimated around 3 billion ounces at recent prices. That's roughly $180 billion to $60 per ounce. Apple's cash reserves reportedly exceed $160 billion. One technology company holds nearly as much cash as the entire global investment silver market is worth. If even a fraction of institutional capital pivots towards silver, there isn't enough supply to accommodate demand without massive repricing. Analysts describing this dynamic as a potential liquidity crisis. When large capital pools chase limited physical supply, prices don't adjust gradually. They gap violently. 1980 provides the template. Silver moved from approximately $6 to $50 in 12 months. Not because of manipulation, because physical scarcity met investment demand and the market repriced to equilibrium. That equilibrium was 733% higher. Here's how you know the shortage is real and not hype. Follow the premiums. Physical silver coins and bars normally trade 2 to 5% above spot price. That premium covers minting, refining, transportation, dealer markup. It's stable and predictable in normal markets. When premiums reach 8 to 12%, the market is stressed. When they reach 15 to 20%, which some bar products are reportedly experiencing, the physical market has decoupled from paper pricing. According to recent dealer reports, popular silver coins are trading $9 to $12 per ounce above spot. Silver bars experiencing premiums of 15 and 20% over benchmark spot prices. Small denomination products seeing even higher premiums as retail demand concentrates on accessible sizes. These premiums don't exist because dealers are greedy. They exist because dealers cannot source metal at spot prices. They're paying huge premiums in wholesale markets and passing those costs to buyers. Some dealer accounts suggest they have paid above spot just to buy back silver maple leafs from clients during previous shortage episodes. Think about that. Dealers paying retail customers more than the spot price to acquire inventory because they literally cannot source metal anywhere else. That's not a functioning market, that's a broken supply chain. Delivery delays extending across the board. Standard products that should ship immediately now requiring 7 to 10 days. Custom or allocated products facing longer waits. Mints operating under allocation systems, rationing production to dealers. The Canadian Mint, one of the world's largest sovereign mints, allocating silver maple leafs. The Perth Mint reportedly experiencing similar constraints. Government mints with direct access to refining capacity struggling to meet demand. This is the retail distribution network approaching failure. Not tomorrow, right now. Dealers operating with razor-thin inventories. Any surge in retail buying, any institutional buyer entering the physical market, any supply disruption, and the system locks up completely. And here's what's most concerning. Retail demand reportedly cooled during much of 2024 compared to previous years, according to Metals Focus data. This shortage is happening without massive retail panic buying. Imagine what happens when mainstream media picks up the story, when the evening news shows lines outside coin shops, when social media amplifies the scarcity. The retail wave hasn't even hit yet, and dealers are already running dry. Silver at $60 per ounce. Some analysts projecting near-term targets of $62, $65 based on current momentum and technical breakouts. More aggressive forecasts suggesting potential for $70, $100 within 12-18 months if structural deficits persist and investment demand continues. The gold-silver ratio at approximately 70-1 has compressed from levels near 80-90 earlier in the year. Historical average closer to 60-1. During periods of silver outperformance or supply stress, the ratio has compressed to 30-1. In 1980, it briefly touched 15-1. If that ratio normalizes toward historical ranges with gold at current levels around $4,200 per ounce, the mathematical implication is silver trading substantially higher. At a 60-1 ratio, silver would trade around $70. At a 30-1 ratio, silver approaches $140. These aren't wild predictions. These are just mathematical relationships based on production ratios and historical precedent. The Earth's crust contains roughly 7.5 times more silver than gold by weight. Yet the price ratio has often sat at 80-1 or worse, meaning silver has been dramatically undervalued relative to gold for years. If industrial demand continues accelerating, if institutional investment flows persist, if retail recognition triggers, if mine supply remains constrained, price is the only equilibrium mechanism. And that mechanism could be shockingly violent. But here's the real risk that nobody is discussing adequately. What happens when the paper market breaks? COMEX silver futures reportedly have paper claims exceeding physical supply by ratios estimated at 100-1 or more in certain over-the-counter derivative markets. Most of those positions settle in cash. But during a genuine shortage, when confidence in cash settlement erodes, when industrial users demand physical delivery, when ETF holders question whether their shares represent actual metal, the system faces a crisis. 1980 demonstrated what happens. The Hunt brothers attempted to corner silver. Exchanges changed margin requirements. Rules modified mid-crisis. Yet prices still exploded to $50 because genuine physical demand overwhelmed paper positioning. This time, there's no corner. There's organic industrial consumption creating irreversible deficits. The squeeze wouldn't be artificial. It would be mathematical reality asserting itself. And governments or exchanges could intervene. Position limits imposed. Margin requirements increased. Trading suspensions, forced cash settlements. But those interventions don't create physical metal. They just suppress price discovery temporarily. If the fundamental shortage persists, if industrial demand cannot be met, if investment demand continues, the pressure builds until something breaks more severely. Right now, this moment, most retail investors don't understand what's happening. They see silver hitting $60 and think they've missed the move. They haven't. They're witnessing the early stages of a supply crisis that could define the next decade of commodity markets. Professional dealers, industry insiders, institutional buyers, they know. They're securing inventory at any premium. They're locking in forward supplies. They're building positions before the recognition spreads. But mainstream awareness remains low. The media hasn't picked up the shortage narrative yet. Social sentiment hasn't shifted. Retail panic buying hasn't triggered. When recognition hits, when the shortage becomes headline news, when retail investors mobilize simultaneously, the physical market could freeze entirely. Not gradually, instantly. Because there isn't spare inventory to absorb a retail rush. Dealer shelves are nearly empty already. Mints are on allocation. Wholesale supply is constrained. Here's what that looks like. You see silver at $70 or $80 per ounce on your screen. You decide to buy. You call dealers. Out of stock? Check websites. Out of stock. Call again. Maybe 4-week delivery, massive premiums, or worse. Some dealers stop taking orders entirely during extreme shortages because they cannot fulfill them. That's what happened in 2008. That's what some dealers are calling unobtainium, when the metal effectively disappears from retail availability regardless of price. During the 2008 financial crisis, according to dealer accounts, some retailers had weeks where the only available product was a kilogram gold bar if you had $30,000 to spend. Everything else sold out. Today's shortage looks broader and more structural because the deficits have persisted for years, not months. The opportunity exists right now for those who understand. Physical silver is still available, though constrained. Premiums are elevated, but not yet explosive. Dealers can still fulfill orders, though with delays. But that window is closing, measured in days, not weeks. And if you're thinking about waiting for a pullback, consider this. Even if spot silver corrects 5 to 10% from current levels, physical premiums are likely to expand by an equal or greater amount as inventory stress worsens. You could end up paying the same total price or more during a pullback because the premium expansion offsets the spot decline. This creates a self-reinforcing dynamic where dips get bought immediately because buyers recognize the physical scarcity. This isn't about trading. This isn't about timing entries and exits. This isn't about outsmarting the market. This is about recognizing a structural shift in a critical commodity market and positioning before the system breaks. Silver has dual roles, industrial commodity and monetary metal. That duality creates unique dynamics. Industrial users cannot reduce consumption significantly without disrupting production. Electronics require specific conductivity. Solar panels need silver paste. EV contacts demand performance. Substitution is limited. Price inelasticity on the demand side. Meanwhile, investment demand responds to scarcity by accelerating. Fear of missing out, recognition of supply constraints, monetary uncertainty, central bank easing. All of these factors drive investment buying, which competes directly with industrial consumption for identical physical inventory. When both demand sources accelerate simultaneously during a supply deficit, the market doesn't adjust smoothly. It reprices in steps and gaps. We could be approaching one of those inflection points. Silver at $60 isn't the end of the move. It might be the recognition phase, the moment when the market begins understanding the severity of the shortage. What comes next depends on supply response, which is limited, industrial demand trajectory, which is rising, investment flows, which are accelerating, and retail recognition, which hasn't fully hit yet. Professional risk managers and commodity analysts warn that silver's small market size makes it prone to violent swings in both directions. The same factors that could drive explosive upside, limited supply, and concentrated demand, could also trigger sharp corrections when leveraged positions unwind or temporary demand shocks reverse. Volatility is guaranteed. Direction over 12-18 months increasingly looks one-sided given the fundamentals. For those already positioned in silver, the strategic question is whether to take profits or hold through what could be a multi-year structural bull market. For those not yet positioned, the tactical question is whether to act immediately despite elevated prices and premiums, or wait for better entry, knowing that better entry might not come and availability could disappear. There's no perfect answer. What's clear is that the physical silver market is under stress unlike anything witnessed since 2008, and the underlying supply deficit is more severe and persistent than that period. The shortage is real. The premiums confirm it. The dealer reports confirm it. The futures backwardation confirms it. The ETF stress confirms it. The shortage isn't coming. The shortage is here, right now. And most people don't know it yet. 72 hours ago, I would have said you had time to research and consider. 48 hours ago, I would have said the window was closing but still open. Today, December 10th, 2025, with silver touching $60 and dealers reporting critical inventory levels, I cannot in good conscience tell you there's time to wait. The retail silver shortage is not a prediction. It's a present reality. The question is whether you understand that reality before availability disappears entirely, because the physical metal is already gone from many dealer shelves. What's left is going fast, and when it's gone, price becomes irrelevant if you can't acquire the metal at any premium. This is not a drill.